Hello, I'm Ryan Lightfoot-Aminoff of Fund Caliber, and today I'm joined by Bertrand Cliquet, the elite rated manager of the Lazard Global Equity Franchise Fund. Bertrand, thank you very much for your time.
My pleasure, Ryan.
It's been a couple of years since we spoke to you on a video, so maybe we can just start with the fund. It's very different from some of its peers. None of the usual names we see in the top 10, like the Amazons, Visas, Facebooks, we see in many other global funds. What type of company do you look for and what do you invest in?
Yes, the name Global Equity Franchise is really the reflection of what we look for in terms of investment and how we qualify these high quality companies we are after. What we look for in high quality companies is companies that will have predictable earnings. So, one of the things that we can get wrong as investors is either we overstate or are overly confident on the future earnings that the company can deliver, or we pay too much for those future cash flows. And what we're trying to achieve with those franchise companies is identify a universe of businesses that have something quite special. We call this the source of economic franchise. So to take some example, it can be a natural monopoly. So we own the National Grid, for example, a heavily regulated business in the fund. They can be businesses with economies of scale, where the sheer size of the business gives them an edge from purchasing, R&D, distribution. So Stericycle, the largest medical waste management business we have in the fund, is another example. It can be network effects, so the likes of Visa and MasterCard, so certainly in it. And by the way, Visa just made its way back into the portfolio. So it used to be a long-term holding, and is now, we sold it, now it's back. We can have companies with brands or intellectual property. So Tapestry, the owner of the Coach handbag brands, is one of those. Or switching costs. Cisco Systems is one of those where it is a very big business decision for their client to move away from their services and products. And what that enables us to do, to have those businesses with superior earnings forecastability, is to be much more assertive on valuation and how much we're prepared to pay for businesses.
And looking at the profile of the fund, you've got a lot less in US companies than most of your peers and quite a lot more in European ones. Is that because of that sort of valuation approach?
That's correct. So the way we build the portfolio is extremely straightforward. We do an immense amount of work defining our franchise universe. So think about those as around 250 companies globally that meet the cut. So which means that from around 2,000 businesses we possibly could invest in, it's really shrunk down to a very, very selective universe. And then what we do on those companies is we do extremely thorough individual business analysis, forecasting, modeling, and evaluation work. And what we do is very simple. We rank the companies in order of decreasing upside, putting the emphasis of the fund on those companies with the greater upside from the current share price up to our view of intrinsic value. That explains, the fund is the reflection purely of stock picking, and this stock picking is extremely disciplined, driven by this value ranking. And if you think about what this value ranking is, and think about them as stacks of bars that grow, decrease, it gives you a really, really nice discipline from a buy and sell standpoint. I think, in my job, there are two key areas. The first one is you fall in love with your winners, because you have a feel-good factor that the stocks you own are doing well, so you feel very satisfied with yourself, and therefore you don't trim existing strongly performing positions to recycle capital. And the other one is the flip side of it. You do not have the assertion to say, okay, this stock has fallen in value while fundamentals haven't deteriorated. That is an opportunity. I will buy it or will increase existing positions. And this value ranking really helps us have a very thorough discipline in that respect.
And perhaps with that in mind, we've seen quite a big sell-off in China. Lots of those funds have fallen, lots of sectors have gone. Are you not finding more opportunities in that sort of China and broader Asia region?
Yes, in China, one of the difficult elements that we found is when we select the stocks in our universe, we have 9 criteria. They relate to, and I'll go very quickly, but the length of the product life cycle, the different levels of margin, how volatile the business tends to be through an economic cycle, and a number of those criteria relate to risk. I know it's not a very fashionable word when we come out of an extended period of rising markets, but we really keep an eye on the different risks that businesses face, and broader risks linked to politics. And obviously, we've seen with the recent announcement in China, they can have a substantial impact, and there is still considerable uncertainty around this. We have a number of these sectors that have been impacted recently, especially real estate, that do not fall into our investable universe anyway. So no exposure to China. We have, however, over the last year, increased exposure and build positions in Japan. So we currently own Secom, which is the largest security company in Japan.
Thank you. And you're also underweight technology as a sector. Is this to do with those 9 criteria, or is it to do with the valuations of the sector, or is it a combination of the two? And do you think this would ever change?
Yes, the tech sector is a very interesting one. So if we'd had this conversation at the back end of 2008, we would have just short of 40% of the fund in the tech sector. So that's when Microsoft, Alphabet, Oracle were in our top 10. And the tech position we had built was very much from 2015 onwards, when the sector had a big question mark over its head, which was the impact of the cloud on those businesses. And we really benefited from stocks at the time. Microsoft was trading on a single digit P multiple, which seems to be a complete oddity versus the current levels. But what this type of uncertainty bring is opportunities. So we did a lot of work on the sector, saying that, well, a lot of companies, as Microsoft has very clearly demonstrated, will be winners out of this transition to the cloud, being able to deliver to clients services at cheaper cost while increasing margins. So, we had a very significant valuation anomaly in this sector. This has significantly closed. There are businesses that have done superbly well, both from an operational standpoint, but the re-rating has been well over what's driven earnings. So we have lower exposure to this sector, waiting for opportunities to occur. And with a number of policy decisions around antitrust, they may come, back for us in the future.
Okay, and perhaps my final question now. We've looked at geographies, we've gone down to sort of sectors and industries. So let's go down to sort of an individual stock level. What's been the best stock in your portfolio this year, and what's contributed towards its performance?
Yes, if you look at the best performer, International Game Technology, IGT, which is the largest operator of licensed lotteries, is a stock that has almost doubled year to date. It's over 6% position in the fund. And what's interesting about it, and it's a stock that was heavily disrupted by COVID. For the first time in peacetime, some national lotteries were suspended during COVID. They sell as well some equipment to casinos. Casinos were shut, and that's a business that has, historically been extremely resilient through economic crisis. So what happened through COVID was a very unusual situation, and the market, very much panicked because this company had a reasonably geared balance sheet. And what we've seen over the last 12 months, and especially since the start of the year, is the company being, returning back to its extremely steady cash flow generation as life has, returned to normal. Added to that, very significant cost measures that have, increased free cash flows dramatically. And we've had quarters when, at the EBITDA level, companies beat expectation by 30 or 40%, which is extremely unusual. So that's what's contributed to such a big rating. Over the last 12 months, the other large contributor was Tapestry, which is the owner of the Coach handbag brand. And what is interesting about this one is that's a company, again, because of store closure that was disrupted by COVID. However, it was a net cash company, very strong balance sheet going into the crisis. And what the market missed completely is that this company was in a transformation phase going into this crisis, whereby they were really streamlining their processes internally to make sure that they were getting the right product to the customers at the right time, to lower inventory risk, lower discounting. And what you get as a result of it is, enhanced revenue per unit, and hence, falling directly into margins. And so, this one has more than doubled over the last 12 months.
Oh, that sounds really encouraging. Congratulations on those picks, and thank you very much for your time today.
Thank you, Ryan.
And if you'd like to find out more about the Lazard Global Equity Franchise Funds, please visit our website, fundcaliber.com. And for more from our video series, don't forget to like and subscribe below.